All right, what's happening, everyone? Welcome to Learn Crypto. This is a project, a concept, a podcast, series, whatever the hell you want to call it. Something that I'm so excited to bring to you guys. It's a bit of a combination of, a failed YouTube series, kind of a podcast idea I wanted to start a while back and never did, and really just also my process for learning things. And I thought, it clicked for me one day. And I don't know if it was the bear market or, what it was. It was everything just kind of came together at once. And I said, let me launch this tonight. I want to launch it today. I want to make an open source catalog for learning about different categories in crypto. Because when you try to learn about new stuff in this space, and there's a huge wide spectrum, right? You have mining, you have investing, you have trading, then you have the masternodes, the technical aspect, development, building, and then just all the fascinating people. It's impossible to be an expert in every single aspect or every single area, right? But it's extremely helpful and beneficial to you, regardless of which area you focus on, to at least have an understanding of what's happening in those other spaces, right? Because each of those are going to apply or kind of factor into what you're doing. So if you're an investor, you have to understand at least a little bit, technical side what's going on. Maybe if you're a trader, not as much, but you need to know what's going on. The same way, if you're, working on master nodes, working on security tokens, it's probably beneficial as well if you understand legal side or what's being developed on that side, right? So there's a few things that I do when I try to learn more about this stuff, and kind of in my process, I've been trying to document it a bunch of ways. This new series I think is probably going to do it the best. There's a few things, probably three things that I try to do when I try to learn about a new topic or a new theme that's coming in. The first thing is I'm going to Google it, or I'm going to go on Twitter, I'm going to look it up, right? Twitter is probably still the best source of information. You have the highest access there. You're eventually going to run out of stuff you can learn on Twitter. At least, let's say we're digging into, something like masternodes, right? Eventually, you're going to learn as much as you can from Twitter. You go to Google. And then past that, you're probably going to run into a few people or a few contributors that know way more than you do, right? So let's say next, I'll focus on everything they're writing about masternodes. I want to see their process, what they know, who they're interacting with, their interviews, every piece of content they've written. And then once that's completely wiped out, you probably have a pretty good understanding. There's always going to be some further questions that you just can't get answered, right? So there's two ways to learn this third step. It's either by doing, or it's by being active and reaching out to them, either providing value, or it's kind of a natural interaction, and you get a chance to get your question answered. I'm still amazed at the access we have that people answer your questions, right? So those are kind of the three ways that I'm going to learn, and I'm still doing that every single day, right? Even the areas that I'm most proficient in, whether it's investing, trading, or it's whatever it is, whatever your strength is in this space, whatever you're most proficient in, you're probably still even not an expert in that, right? I would never call myself an expert in anything. I'm always trying to learn more. So no one's an expert, even probably, there's very few experts even in one field. No one's an expert in all fields. So I thought, what better way than to completely open source the way that I'm learning about new narratives, new themes, new topics, kind of spreading how I'm learning about this space, decentralizing it, making it open source, making a framework for you to also learn about that, so I can provide value to the community that's given me so much. This is probably a movement, if you want to call it that I'm probably going to spend the rest of my life working on. There's so many things to learn. I have endless questions. There's so many fascinating and driven and truly kind people that I've had the chance to meet and worked with and connect with in this space. And I absolutely love it, and I kind of want to share that with you guys. So our first episode, we have Anthony Pompliano, aka Pomp, talking about security tokens. I'm so excited to dig into this interview. We talked about a lot of good things, narratives, themes, where we're going next, how to compare it to last year, legal, maybe what's going on there, different investments, how you can get involved, investments he's looking at. Pomp is someone I wanted to have on the show or wanted to kind of have an interview with for a while. I had the chance to speak with him early 2018. We were talking about utility tokens and certain investments and maybe how crazy things were getting. And now seeing how his kind of approach has evolved, the different things that he's working on. And earlier, like I said, whether you agree with ideas or topics or or people on the show, what they invest in or what they believe in or the way they're disrupting. That's not the point. The point is to learn from their experience, from their successes, from their failures, from all the above, just from them as humans in this space. And Pomp is someone that I respect, that I've learned a ton from. I think it's his optimism, his enthusiasm for the space is something that everyone maybe wants to mirror. I mean, he started an absolute movement with this Tokenize the World, and kind of put security tokens at the forefront of discussion for at least a week, at least a month, and I think it's still being talked about in large part due to a lot of the information that he's presented. So I'm excited to get this going, kick it off. I'm excited for all you guys that are here. Let's do this. Enjoy, guys. Thank you so much for watching. Tell me what you like. Tell me what you don't. Say what up. Tweet at me. Share it with your friends. Do whatever the hell you want. Enjoy the show. Keep earning that Bitcoin. Let's get it going.
This is the Venture Coinist audio experience.
We're going to be talking about security tokens. I'm excited about this episode. Big theme. There's a lot of talk about this in the last couple of months. So who better to have on than Pomp? Really appreciate you coming on and taking some time to talk with me. I know from listening to your interviews and studying a little bit more about your background. I remember when we talked earlier in the year, I wanted to understand where you came from. Military background, traditional finance, the VC world, and now coming to strictly blockchain, working with Morgan Creek. And how did you get to this blockchain focus in this Tokenize the World movement? What was the transition like, and what drew you here?
Absolutely. Yeah, so started out, played football in college, Bucknell University. Then 6.5 years in the U.S. Army, did a deployment overseas, came back, did 2 small technology companies, sold both of those, then went and ran a number of product and growth teams at Facebook and Snap. About 2.5 years ago, started Full Tilt Capital, early stage venture fund, completely stage agnostic, just trying to find the best people to back as early as possible. So did about 64 deals in an 18-month period. Fund was going decently well. And we noticed a couple of trends. So one, founders who wanted to start companies were starting to look more and more into the blockchain space. Then we saw some of the top talent at companies we had invested in start to go into the blockchain space. And then the third was we started to see some of the money from co-investors flow into the space. And so when I first started investing, somebody who I greatly respect told me to basically follow the talent and follow the money. And so we started to dig deeper into the space. My partner and I, I think we kind of understood the utility token and ICO stuff, but we couldn't wrap our head around actually investing other people's money into it. We thought it was very high risk, high reward. We couldn't underwrite the risk. And so we said, that's probably not for us. We started building mining facilities first. So this whole idea of I can invest in hardware and infrastructure, it's a cash flow business, and I'm somewhat protected from the price volatility. So today, if Bitcoin goes up or down, I don't care. I'm still making more Bitcoin. And so that cash flow component helps reduce some of the risk as well. And so while everyone else is trying to compare crypto returns against crypto returns, hey, you did 17x last year, I did 18x. We really looked at it as, can we find businesses that are analogous to kind of the non-crypto world, but they can drive better returns than that non-crypto world. And so if you look at mining, it's cash flow, it's infrastructure, it's kind of like real estate, etc. So a lot of the similarities in terms of how people look at from an investment process or an investment thesis, but obviously the returns, 10 to 18% monthly cash-on-cash returns are much, much better than kind of the anticipated anything 10 to 20% annualized returns in real estate. Yep. And so once we did that, we just kind of kept going and going, looking for more businesses like that. And one day I randomly said, I think that every asset is going to get tokenized. And we can kind of dig into what that means, but I used the hashtag Tokenized the World, and here we are. Just kind of took off. Yeah, to say the least. It's funny. So we had a conversation. I think it was early this year or maybe late last year, and we were kind of diving into the ICO space and maybe how crazy
just even the process was of kind of it was becoming really a fight for allocations. A lot of those allocations weren't on the white paper at all. Those allocations didn't give you a right to anything anyways, and you guys made that decision, your fund, to kind of stay away from that. Like you said, you didn't think it was right to be investing other people's money in that. Seemed a little bit too speculative, and now you think you're better positioned going forward. Kind of what's the reason for that? What are security tokens? I saw you talk about Bitcoin being programmable money. This is kind of programmable ownership. So what does that mean? What are security tokens? Just really simply.
Yeah, so I shy away from the term security tokens, and I usually talk about it as like tokenized securities, which on the surface sounds not that big of a deal, right? But really the thought process here is a security is any tradable asset, right? And when you think of that, there's only so many types of ownership or securities you can own. So you can own equity, you can own debt, right? You can own currency, et cetera. And so in that, today, or really since the beginning of time, right? The way I usually describe this is since literally the first pieces of human history, there was ownership, and we would write it down, right? That's how we knew who owned what. And so literally we would chisel it into, literally stone tablets, then eventually on paper, et cetera. And at some point we get to the share certificate. And so the share certificate, in order for us to transact that share certificate, we used to have to do peer-to-peer transactions, just with no computers. So literally I had to come find you and say, hey, I've got X asset, you've got Y asset, why don't we barter or exchange those values? And so it was like the first original peer-to-peer transaction. That's not very efficient, and I have to physically come find you, right? So there's all kinds of inefficiencies there. In 1602, the Dutch East India company said, look, we want to create a marketplace. And so in what is now known as the Amsterdam Stock Exchange, in 1602, they set up a single physical location that anyone could come and trade that one company's specific stocks or bonds. And so once you all come to one location, now you start to create a little bit more efficiency. As long as you come to this location, you can trade these stocks and bonds, but we're still trading paper, and I still am doing a peer-to-peer transaction, right? Over time, that evolved, and there became more and more physical locations to trade, right? So New York Stock Exchange, et cetera. And what we used was something called the open outcry method. The open outcry method is literally we stand and we talk or yell different bids and asks, and eventually we come to some sort of consensus that that's the price that we're willing to transact, and then we consummate the trade, right? So we go from 1602 to like the 1970s and 80s, when we're still yelling and screaming at each other trying to do transactions of physical pieces of paper, right? Which sounds pretty ridiculous.
Yep.
And so what ends up happening is we go from that analog world of ownership or securities to an electronic world. And in the electronic world, what we got was there's still physical paper. So today when I buy a share of Apple, I can still call Apple or the custodian and say, hey, send me my physical share certificate. But what I'm able to do is I'm able to log into different trading platforms, and I can transact that share electronically without having to actually take custody of the paper. Right. And so what that does is, again, it just increases the efficiency of the market. We don't have to move the physical paper around, even though we're based on paper, and we can just do this through an electronic version. Now, a few problems with that. One, there's incredible settlement times, 2-3 days, depending on the different technology. Two, it's a very Western-centric financial system. Three, the stock market is closed more hours a week than it is open in the United States. Right. So literally in 2018, we have a stock market that is closed more hours than it is open every single week. And then additionally, it's closed on days of the week in other countries. So in some countries, Friday, Saturday is actually the weekend.
Monday, yep.
So on Sunday, which is their Monday, it's closed. They cannot do business because we in the Western world have closed our stock markets. And so it's just a very inefficient, not well thought out process. Now, when I go to quote unquote tokenized securities, what we're really talking about here is the idea of going from electronic version to a digital version. So rather than move these, blinking lights on the screen that represent paper, what we do in the digital world is we completely get rid of the paper. If you hold the digital share, the digital token, right, with the public-private key, then you are actually holding the legally binding share of ownership in that entity. And so what it does is, again, you slowly are chipping away or evolving this technology to, one, create a more efficient system, two, allow for more global investor participation, three, have lower fees when you're actually doing these transactions, And then 4, and probably the most controversial one today, is you actually make a more compliant system. So outside of the tokenized security world, there's all of this regulatory uncertainty, right? Are these securities? Are they not? Who should you sell them to? When can you sell them? How can you market them? All of this stuff that I think a lot of people are waiting to see how regulators will come down on. In the tokenized securities world, we know all those rules, right? It's very clear. This is security. Here's the rules, depending on the exemption or the offering status, what jurisdiction you're in, who you're marketing it to, how you're marketing, etc. And so when you digitize this, you can literally write the rules or the law into the code, and the code can proactively prevent people from doing things that are non-compliant. So an example of that would be something like, if I'm an accredited investor, you're unaccredited, there's a Reg D offering, I've purchased that Reg D offering and I'm holding the security, I'm holding the token in my wallet.
Right.
Well, the system knows that I'm accredited because my wallet's been KYC, AML, investor verified, etc. So has yours, so they know you're unaccredited. And inside the token, we've written in all of the criteria for the security. So we know what company, when it was issued, what jurisdiction, everything. And so when I go to try to transact that, whether through an exchange or a peer-to-peer wallet transfer, the protocol recognizes unaccredited investor trying to purchase from an accredited investor a Reg D security, non-compliant trade. It rejects the trade and actually doesn't allow us to do the trade, tells us both why. And so now, rather than us consummating that trade and regulators having to come and build a case and figure out that we did something wrong and spend a bunch of money, time, and resources to enforce on us, now we're able to just use the code to actually prevent people from doing these things. Because mostly they're not trying to be malicious. They're just doing things they don't know they're breaking the rules. And so I think that's where a lot of this excitement's coming from. And then to kind of circle it all around, like today we call them tokenized securities, but eventually we think that we won't call them tokenized securities. We're just going to call them securities.
Yep.
And the example I use there is like when you buy those Apple shares today, nobody says, hey, I bought electronic Apple shares settled by the DTC, right? We just say I bought shares of Apple. And so I think, maybe 5-10 years down the road, but eventually we'll do the same thing here.
Yeah, that's kind of an interesting parallel at the end. I remember when I was in high school, I visited the CME and I visited New York Stock Exchange. And visiting the CME first and still seeing open outcry, and that was really cool. And that's what you see pictures of, and that's what we saw in movies back then. And then you go to the New York Stock Exchange, and we were walking on the floor, and we were the only group down there. There's maybe 4 other guys, and then there's CNBC, and that's it. It was only news anchors. There's no more traders. There's no more open outcry. So kind of that evolution of that just becomes the new norm.
So the computers are yelling at each other on the stock exchange, right?
Exactly. Well, that's how it probably was anyways. I mean, exactly. So talking about kind of the future and kind of picturing that, giving that visualization of, let's say one accredited investor tries to do a transaction with a non-accredited investor, what happens then? And you guys made the decision, like I said earlier, to kind of stay away from some of these utility tokens and unregulated securities in the ICO space, and you think you're better positioned going forward. What does that mean for people that maybe were hitting home runs in 2017? They're still kind of going after these unregulated ICOs. How are they positioned going forward? Kind of what happens to them?
Yeah, so I think there's a couple of things here. So one is, I tweeted earlier this year and I said, who thinks that in 2017, the crypto hedge funds on average performed about 700% on the upside, right? Traditional hedge funds performed somewhere between, I forget the exact number, but it was sub 30%, right? It was like 50, 20%, whatever it was. And so between 700% compared to sub 30%, there's a huge delta. Right. And so most people, I think, thought over time, like, oh, we're going to slowly see compression and eventually you'll see like a equal type of performance. Well, I already think in 2018, there's a chance that the traditional hedge funds may outperform the crypto hedge funds. Right. And the reason being that some of these funds took 60, 70, 80% drawdowns in Q1. And so what you get is there's a Howard Marks quote that I always kind of defer to. And Howard Marks runs Oak Tree Capital, one of the best performing funds. And he basically says, look, and I'm paraphrasing, in order to have top 5% of all returns, you have to take such inordinate amount of risk that when you're wrong, you end up in the bottom 5%. Right. And so in order to be willing to be in the top 5, you have to be willing to be in the bottom 5%. And so what ends up happening is you see this just volatile performance where, last year there's funds that are up 15, 20, 30x, and then they turn around and have an 80% drawdown in Q1. Now, a lot of people would argue that, yeah, if you're up 15 and you draw down 50, you're still up 7.5, right? And so true, But what ends up happening is you have really, really unpredictable performance, and it all matters about an investor's entry point. And so what Howard Marks goes after is he says, look, I don't want to be in the top 5% because I'm not willing to be in the bottom 5. All I want to do is I want to outperform the average every single year over a 10, 20, 30-year time period. And while everyone else is going up and down with their volatile return profiles, if I just consistently outperform the average over a long enough timeline through the law of attrition, I end up being one of the top 5% investors, but I never had to take enough risk to end up being in the bottom 5. And so I think that's really our mentality going into this is like, look, the types of investors that we have capital from and that have entrusted us to go and invest their capital, so basically they don't have the appetite to be top 5, bottom 5. And so I think that really what they're looking for is they're looking for a way to participate in what ends up being one of the riskiest asset classes in the world, but do it in a risk-adjusted way. Yep. Right. And so that's really where our focus is how do we help these institutional investors participate in a market that has incredibly high potential, but do it in a way where we can constantly protect against the downside. And so what ends up happening is in order to protect against the downside, you got to give up some of the upside. And so I tell people all the time, look, I'll gladly give up upside in order to have higher level of confidence that we won't go to zero. And so I think that it's just a different way of looking at investing. And so, there's each type of investor wants something different. And so from a capital allocator standpoint, what you want to do is you want to figure out what strategy fits what type of investor, and then you want to play matchmaker, right? Okay, here's my strategy. I got to go find investors that think this strategy is interesting, and that's all we're doing.
Yep, that makes sense. So still going forward, still no plans, I'm assuming, to touch any kind of utility token offering or pre-market anything utility-wise.
Yeah, so I think for us, there's a couple of things. So the utility tokens are unregistered securities only because of certain aspects. So one is if you create a utility token today and you disperse it without any sort of financial offering, right, you drastically reduce the likelihood that you're a security. There was no offering. You didn't fundraise, right? So that's one piece we look at. Two is even if you fundraise, if you go ahead and you file the correct paperwork and you only take money from the right type of investors depending on the regulatory framework you're using, you're fine, right? You're basically acting like a security. So we think that there's a world where a lot of these utility tokens actually just use the securities regulatory framework, and they continue to act like a utility, right? Some people think that's not fun. Some people think that's not interesting. Some people actually think that's the wrong path, right? But we think that's the kind of, again, safest, most risk-adjusted way for a utility token to come into the market with the highest probability that they're not going to get in trouble.
Yep. Okay, so that's cool because it leads into kind of the next thought. I think a lot of people understand, securitized or tokenized securities, and looking at maybe tokenizing, stock or tokenizing real estate. What about those utility tokens? Kind of like you just said. Let's say a normal ICO. I think a lot of people can relate. A lot of people have been in an ICO. Let's say an ICO is raising for a decentralized exchange. They're raising money for that exchange. Pretty much, they're an unregulated security. They're a utility token. If that utility token, let's say it does follow kind of all those rules and only does private placements or things like that, follows all those securities, is that kind of a tokenized security you want to be into, or are you only kind of looking at asset-backed or traditional securities that are going to be tokenized?
Yeah, look, we constantly talk about this in terms of there are ways to act like a security and be compliant within the security framework, but not give the investor rights or recourse of a true security, right? And so what we mean by that is what we're specifically looking to do is we would like to, in the early days, invest in things where we get equity, we get some sort of recourse debt, or we get some sort of claim on future cash flows. Right, so those three things are really interesting to us because they are they're much more advantageous for an investor. Now, a lot of people say, well, what if I issue a utility token? Which, in my eyes, a utility token is merely an incentive, right? And these incentives previously, before the advent of tokens, was badges, streaks, points, gift cards, all these different things, right? And so now we just have a better version of that. But if you told me, hey, you can invest in Chuck E. Cheese, the company, or you can buy some of the Chuck E. Cheese tokens before we build the location, they're going to take that money, build the location, and then you can come in and use your tokens, right? It's just not as interesting to me to buy the tokens first, right, and then go use them once you've used my money to build the building and the company, etc. I'd much rather just invest right out of the beginning and get equity or get a piece of the real estate, etc.
Yep.
And so I think that people will do all of what I just mentioned, and they will do it in a regulatory compliant way. For us specifically, we're much more interested in this idea of the equity, the debt, or the cash flow. And less interested in the incentive side of this for now.
Yep, giving rights and okay, that makes sense. Kind of also, once again, comparing those real assets or tokenized securities back to utility tokens. There's a few scenarios where I think those incentives make sense. Maybe exchange tokens and you're incentivizing or lower fees, and possibly you have a right to the cash flows, whether or not you're staking or something. But for a lot of those, like you said, they're really just kind of discounts or a lot of utility tokens, what they're doing now, projects are kind of almost reverse engineering utility now that they've created this project of how do we somehow make this utility token worth anything. At what point do you think real estates or tokenized securities or these asset-backed securities, asset-backed tokens kind of engulf that utility token or that engulf that incentive token market? Because I know there's so many themes you talk about in crypto, right? Decentralized exchanges, last year is supposed to be the year of decentralized exchange. This year is supposed to be the year of decentralized exchange. Kind of how long does this actually take?
Yeah, so there's a lot of 10-year successes, right, or overnight successes, if you will. And so I think that's what we're seeing play out here is like people forget that in order for majority of what we are talking about to come to fruition across blockchain and cryptocurrency markets, somebody needs to sit down and write code, right? Mm-hmm. And somebody needs to actually build this stuff. And so it is not unnatural for us to be excited and to have a vision of what the future may hold. And then there be a lag between us seeing it and it actually being live, right? And then being built. And so I think that's what we're kind of experiencing now. Now, here's the exciting part is the crypto markets move so fast, right? When we joined Morgan Creek and started doing all this stuff, one of the things that Mark Yusko, our new partner, continued to say is like, look, there's a difference between Creek time, right? How Morgan Creek has historically moved as a large financial institution that manages billions of dollars, and crypto time, which basically is a decentralized organization and how quickly they can move. And it's little things, right? These financial institutions, they operate in a world where they send emails for everything, right? Well, there's not a lot of emailing going on in crypto, right? Yeah. There's Telegram and text messages and Twitter, and just the information flies around so much faster. And so I think that you not only see it in the technology, in the way communication happens, in the way investing happens, and so really the part that I think excites me is we've already seen some tokenized securities occur. We'll see more of them happen. And really the part that I think will accelerate this is where is that institutional capital going to come into, right? And so there's a couple of things, and this tweet's from about the other day, there's a couple of misconceptions about the institutional capital, right? One is they're not coming to save crypto, right? I think that they want some exposure, but they look at it from like an exploratory budget standpoint. They're going to put, tens of basis points towards it. They're not going to go put 100 or 200 basis points into Bitcoin or anything like that, right? And why? It's because of the risk profile, right? In crypto, we ask how high can it go? In the institutional world, they ask how low can it go, right? Just like those two things are at odds with each other. And so I think that's one. Two is most institutions have buckets of capital that are pre-identified. Right. So, hey, this is our equities bucket. This is our, real estate bucket. This is our commodities bucket, whatever it is. Right. And so when people go to pitch these institutions for capital, what they end up doing is they're walking in with an asset that there's no bucket to come out of. Right. The institution looks around and says, well, what bucket of capital does this come out of? And so with tokenized securities, when you go and you say, hey, we're going to go buy real estate, it comes out of the real estate bucket. Or we're going to go buy equities, it comes out of the equities bucket. Right. And it's an asset that they already understand. And so what you're doing is, again, going back to when you've got a strategy, you got to go find the investors that are attracted to that strategy. The institutions are much more attracted to the asset classes that they already understand. There will be some absolutely that go into this new asset class. It's just going to take a lot longer, and it's going to start with much, much smaller checks than I think people realize. And then the last part is, and this, it took me a while to understand this. You got to go down to the most human fundamental level, right? Those portfolio managers have absolutely zero financial exposure to the upside of their business. So they are not incentivized. If they make an extra 2, 5, 10, or 50% in their portfolio returns this year, their compensation will not change, right? They are not incentivized on any sort of correlated or causated, process. And so in that, what ends up happening is if I have no economic upside, I actually have all downside. Because for me to take additional risk, the only thing that can change is I get fired because it doesn't work out and I lose money.
Yep.
And so when that starts to play into this, you're not only fighting the institutional kind of structure, but now you're also fighting the human element, right? It's the greed and the risk. And so I truly believe that these institutions are much, much more interested in tokenized securities than the crypto side of this. Does not mean that the crypto side can't be successful. We tend to be incredibly bullish on certain aspects of that world, but I think that separating kind of how these institutional investors allocate capital between the two markets is really important.
Yep. Yeah, it's an important part you brought up about downside versus upside. I think one of the most interesting parts about watching kind of the whole market react to different partnerships and funds coming into the space is you see a coin or a project. Let's say they partner with let's say they partner with Intel, or let's say they partner with Starbucks, whatever it is, and all of a sudden people are start saying, there's going to be this inflow of $100 million into this coin because all these funds are going to jump in. Funds aren't going to be market buying those type of coins, like you said. They're going to put small, whether it's 10 basis points, they're going to put small allocations because it helps their overall portfolio metrics and hopefully it improves their Sharpe ratio. So I think that's important to understand upside versus downside, what they're incentivized to do. That's a good point. Looking at
and one other thing I'd add to this, right? So my partner says all the time, if you think of the utility token market today, it's early stage venture capital. That's all this is. It's people with an idea that are getting funding to go try to build that project, that platform, that service, whatever, right? And so if we expect early stage venture capital to have a very high rate of failure, we should also expect the utility token market to have a very high rate of failure, right? It's just early stage venture capital in a different form. And so most of these institutional investors do not play stock picker in early stage venture capital. They go and they find professionals who are doing that, right? But it's a venture investment. And so they back a fund. That fund then makes the individual selections. And usually the institution will go to that fund manager and say, give me your best idea, and I'll double down or triple down on that investment as it's growing.
Yep.
Same thing in the utility token market. These institutions are not going to go and try to pick the next best ICO. What they're probably likely to do is take some allocation of their capital base, probably from their venture bucket, give it to a fund manager, say, hey, pick the best ones. And if there's one that's just absolutely out of this world in terms of performance or upside or whatever, let us know, and maybe we'll come in as a co-investor. Yep. Right? But again, same exact mechanism, same pool of capital it's coming out of. And so, again, it's almost this, it's like the saying, the more things change, the more they stay the same. Like that's what we're watching play out here.
Yep, and it's funny watching that play out. You talked about the high rate of failure for early stage ventures. Looking at ICOs and even my performance, or other investors that I see on Twitter and in the space, I think a lot of us had me as well. I think a lot of us had more projects that went 2, 5, 10x than even lost money. And if your hit rate is that good, while early stage venture, the failure rate is that high, there's a mismatch, especially when supply is this big and the ICOs are coming out faster than they ever have. So it's going to catch up eventually.
Absolutely.
Yeah. One of the questions I posted to Twitter yesterday before I started the interview is, what do you guys want? What kind of questions do you want answered? What are you dying to ask? And what they asked was, how do we invest in these tokenized securities? Will the average retail investor even be able to, or is it all going to be private placement? Is it all going to be accredited investor? I think that's also one of the reasons why there was a pushback on Twitter of, this is simply a revolution. This is kind of away from this evolution that we've created, just making the rich richer, only kind of benefiting accredited investors or funds. So where do they get in?
Absolutely. Yeah, so I think there's a couple of pieces here. One is there are multiple ways to participate, right? Obviously, this isn't financial advice, etc. I think that one is there are early stage opportunities to invest in platforms, right? So these are exchanges, issuance platforms, protocols, etc. I think that there are ways to invest in individual projects. So a company is tokenizing their equity, a building is tokenizing their real estate, a REIT is tokenizing, all that kind of stuff.
Yep.
And so just like you would invest in the stock market, being able to invest in these. And then I think that there's a world where on top of that, we're going to get a derivatives market, right? And so what people are going to do is they're going to end up bundling all of this fractional ownership. So somebody's going to say, all right, you've already tokenized all the real estate in New York City. I want to invest in the Lower East Side, or I want to invest in the West Village, short or long, right? And we'll kind of see all of those derivatives get built. Now, here is the part that people have to remember, right? So the second that I see 5, 10, 15, 30x returns, once in a lifetime opportunity, not sustainable, right? And so when you go back and you look at, okay, well, what is the security token kind of return profile going to look like? It's probably going to look much similar to the existing world than it is that 5, 10, 30x returns, right? And again, that is okay. The reason why you see those 5, 10, 30x returns is because it's early stage venture capital. High risk, high return, high rate of failure, right? What you're going to see in the security token world or this tokenized securities is much more similar to this idea of, can I drive 10, 15, 20, 30, maybe 50% annual returns in an asset class that has a very, very low rate of failure, right? And has much, much lower risk profile. And so because of 2017, everyone's like, that's so boring. Well, guess who's not bored by 30% annual returns? Every single traditional investor, right? And so I think what we're seeing here is this convergence or collision of the expectations of 2017 are going to be met with the realities of 2018 and beyond. And so I challenge a lot of people to just kind of reset their mindset. Don't compare what you see to crypto returns. Compare what you see to traditional returns, because eventually that line is going to get so blurred that they will become traditional returns by definition. And as long as people continue to see a higher rate of return from tokenized securities, et cetera, than the non-tokenized world, then I think it will be attractive to people, right? And so this whole idea of like, what is your benchmark or what are you anchoring against is really important when you're looking at returns or how you participate in a market.
Yep. One more question kind of building off that I think what sparked a little bit of the controversy kind of building off that is, I've heard you talk about in the past, one of the interviews, one of the lines that I'll always remember is, I think it was Rand or someone else asked you, are you selling or are you buying Bitcoin here? And you said, I'm always accumulating Bitcoin. I'm always in accumulation mode. So someone who's so bullish, and I've heard you talk about it, so bullish on blockchain as being programmable money, as being a store of value and everything it represents, everything it's already accomplished, and is also bullish on these tokenized securities and think they have the possibility to definitely kind of capture more assets and bring more institutional investors in. Can you be bullish on both? I know on Twitter we saw a lot of pushback, whether it's from Bitcoin maximalists or people that kind of, whether they don't understand or they simply don't agree with kind of what tokenized securities stand for, what they're doing. Can you be bullish both, and are you still bullish Bitcoin as you were?
Absolutely. So I mean, look, here's what kicked a lot of this off is I said that tokenized securities will be more disruptive on a global scale than Bitcoin. Right? And I used a bunch of data and facts. And so a lot of people didn't like the fact that I said that an initial sentence, tokenized securities will be more disruptive than Bitcoin.
Yep. What
a lot of the folks who pushed back, what they did not understand is I'm incredibly bullish on Bitcoin, right? And we actually think that most of the people are underestimating what it can accomplish, right? And so the issue here is in crypto that there's a couple of things that have kind of surfaced and have embedded themselves into this community. One is this binary thinking. Either you get A or you get B, and there's no other options. Well, the real world doesn't operate so black and white. Everything is gray, and there's a whole lot of stuff in between that black and white, right? So that's one. Two is just because you believe something is going to be valuable, like Bitcoin and like we do, does not mean that you can't think something else is going to be more disruptive in nature, right? And so obviously we said what we said. Now, here's the part that, just absolutely throws me for a loop a lot of these times, these conversations, is I come out and I say a statement. I clearly articulate, here's what I believe, here's why I believe it, here's facts to back it up, and here's data to back it up, and here's the site or the source of where I get that data, right? The people who respond, and usually it's coming from the hardcore anarchist focused Bitcoin maximalist crowd, is tokenized securities are a cancer. You're a charlatan. You're, all this stuff. And so what I said was, look, guys, I use the term Bitcoin terrorist, right? And I use this term for a very specific reason, because what it does is terrorists, how they rule, right? Sometimes they rule by violence, and sometimes they rule by fear, right? And so this idea that people can't have a different opinion than you, and if they do, you attack them, you threaten them, you literally create fake Twitter accounts, you create fake Medium accounts, you go on this like propaganda campaign because they have a different idea than you, is absolutely ridiculous, right? And it is actually what terrorists do. Now, I use that terminology because it would get people's attention, right? And so here's the best part is when I said that, right, it only inflamed them doing it more, right? And so I've said it all along that anytime I say something on Twitter and I get a pushback, because it makes people uncomfortable, it usually means I'm on to something that has power, right? And so, in this scenario, what I was saying and what I clearly articulated was Bitcoin has incredible value. We are incredibly bullish on it, right? I mean, earlier this year, I literally said that Bitcoin could potentially go to $50,000 this year in price, right? I haven't seen anyone with a higher price target than us, right? So
I see a few. I see a few on Twitter here and there.
There may be some, right? There absolutely may be some, and those people are even crazier than us, which I love, right? But what I think I see is a world where Bitcoin, if it disrupts all of the money in the world, all of the gold and all of the silver, it's $100 trillion of disruption. That's how you measure it, right? The total market cap of what that asset is worth would be $100 trillion. Global real estate is only a $215 trillion market. So one other asset class is twice as big if Bitcoin accomplishes everything people think it could accomplish, right? And that means that Bitcoin isn't just another type of money. It means that every other piece of money and every piece of gold and every piece of silver, all of that value has to go into Bitcoin, right? Possible. That would mean that each individual Bitcoin, if we didn't lose a single one of them, would be worth over $4 million a token, right? I think even the biggest bulls say we either got a really, really long way to get there, or that's really stretching what we think the potential of this is, right? Now, when you go over to the real estate side, people say tokenized securities, you can't say that $215 trillion of real estate is going to go into tokenized securities. What they don't realize is today, paper has $215 trillion of real estate market cap. Tokenized securities is not disrupting public markets. It's not disrupting all this other stuff that people are comparing to. Tokenized securities is disrupting paper. And when you look at it that way, well, all of a sudden, tokenized security seems a lot more disruptive because it's going to disrupt $215 trillion of paper ownership in real estate, right? $200 trillion in derivatives, or whatever all this stuff is. And so what I get to is this idea of everyone wants to look at disruption as value creation. I bought something at $1 and now it's worth 100. That's disruptive, right? What they don't realize is, from our perspective, disruption can also be value transfer. It doesn't have to be value creation. So if I own an asset that is worth $10 and it's on paper, and now I'm going to shift that same $10 to a digital piece of ownership, that is still disruption. It's not the type of disruption everyone wants to talk about, because everyone wants to talk about the 10, 50, 100x returns, but it's actually probably more disruptive to have value transfer than value creation. And so, when you kind of really dig into these arguments, the problem that people have is that these are uncomfortable, right? Because we're so tied to this idea of, value creation, greed, returns, etc. But what ends up happening is, if you compare the venture capital world, right? And the returns that drives compared to the private equity world. Private equity is able to put more dollars to work, right? And yes, they have a lower return profile, but in most cases, private equity has a higher cash-on-cash return than venture capital does. And so what you're literally looking at is pure disruption versus kind of boring disruption. And boring disruption just is by nature more disruptive on an aggregate basis because it's bigger dollars. And so that's not the sexy conversation, but on an aggregate basis, it is true, right? The data shows us that. And so I think that's where the pushback comes from. And it's just two separate people or two separate factions of individuals looking at each other and having an argument because they're coming at it from two different perspectives. And frankly, they're banging their head against each other and they're not willing to kind of see the other side.
Yep. And I think that's what's important. And you brought up a good point. So much gets caught up in kind of maybe inflammatory words, and I think both sides use them. And we see it all the time in crypto and the certain kind of tribes that form, whether it's Ethereum versus EOS and all this type of stuff. It's two different types of disruption, but also the same thing, whether it's ideological or whether, like you said, it's paper and it's just a transfer. Maybe it's not a 10x or 20x, but it is a transfer of that coming from paper to this. I think there's disruption in both sides, and maybe how you measure those is kind of what's being argued over. But clear disruption on both sides, and I think more people should kind of look at it like that, of both can kind of happen, just like you said. So the last thing before I let you go, the other one was, what projects, what platforms are you looking at currently in the space that people can get involved in? You talked about the average person can get interested or can get in, can get involved. Is it T0? Is it Polymath? Is it these private placements? How can they get in, and what are you looking at?
Yeah, so from our strategy, there's kind of two separate buckets. So what in the steady state we would like to do is we would like to finance all of the tokenized securities, right? Meaning that if you've got an asset in the private illiquid market, you want to bring it to the public liquid market, we would like to help you do that by financing, right, some of those activities. And we think that not only is there value to be captured from private market to public market, we also think that there's traditional value to be captured by capital appreciation, cash flows, et cetera. Once you're already in that public market, you continue to stay in the public market, right?
Okay.
In that public liquid market. So that's kind of steady state where we want to be. In order for that market to exist, there needs to be a bunch of infrastructure, right? And so we're also looking at, in the short term, on a much smaller basis, funding a lot of that infrastructure development so that we can get to the place where we want to operate with an existing market with existing infrastructure, et cetera. Now, in those areas, what ends up happening is you can take one of two approaches. You can try to play kingmaker and say, I'm going to pick the one winner and I'm going to bet on that winner and I hope they win the whole thing.
Yep, winner takes
or
all.
You can take a much more agnostic approach to the market, and you can say, look, I'm actually going to bet on all the exchanges. I'm going to bet on all of the protocols. I'm going to bet on all of the issuance platforms. And I'm going to do that because I need them to be successful, and the one or two winners are going to pay for everybody else, right? Yep. Traditional venture capital model. And so we're choosing to do the latter, right? Where basically we take an agnostic approach to the market. We say, if you are building an exchange for tokenized securities, if you're building an issuance platform, if you're building a protocol, a wallet, whatever it is, we want to talk to you because we think that we've got the ability to, with capital and kind of, our expertise or kind of our experiences, help you develop that much faster. Right. And so if you're a retail investor sitting at home, et cetera, and again, not from a financial advice standpoint, but from a, where to go look or where to go learn, I think really that there's kind of two ways you can play. You can try to participate as a venture capitalist and go invest in these private deals. Right. And that tends to be you got to be accredited investor and all this stuff. Or what I think is probably more likely for most accredited investor or most investors in the U.S. is you can actually be patient and wait for these deals to come, right? And so when somebody takes, a trophy asset in real estate and they tokenize it, there's gonna be an opportunity to invest in that trophy asset, right? Mm-hmm. And on the way into the public market. And then obviously you can also invest once it's in the public market. And so what I always tell people is everyone wants to get in at the earliest stages, right? And they want to get the big wins very early. The richest guy in the world actually made, who knows if it's Bezos or Buffett today, right? But Buffett, I'm specifically talking about, he made his money by investing in the public stock market, and then he started compounding, went into the private market, etc. Right? But he made his initial wealth in the public stock market. So it's not a world where you have to get into the private markets, right? It helps in some cases to get into private markets, but it also hurts if it goes to zero, right? And so I think that people just need to figure out, what is my strategy? Do I want to have a venture capital approach? Do I want to have a public equity type approach, right? Where do I want to play in this market? And then once they understand that, then you really got to go find what are the great deals, right? So you want to play a venture capital model? Great. Go find all the teams that are building infrastructure in the tokenized securities world, right? Who's building the exchanges? Who's building the issuance platforms? How do I get into those deals, right? That game. If you want to wait and play public equity stuff, then okay, what are the deals that are being tokenized? Where are they trading? How do I buy them? How do I custody them? And what do I think is going to have the appreciation? But I think people are kind of jumping ahead and saying, just like, how do I get rich? Right? And like, I get it, but also like, nobody just kind of, snaps their fingers, wakes up, and bam, they're rich without a plan and executing that strategy. And so I think that's the part that gets lost in that question that, is really important for people to hear and kind of go back to figuring out what they want to do.
Yeah, it's a sobering thought in maybe a market that needs it coming off 2017.
Look, 2017 was absolutely epic. Right? I don't think I'll ever live to see something like that ever again. If I do, I don't know if that's good or bad.
Yeah.
Right? But what we saw last year was absolutely incredible. And there's plenty of people who made money, right? There's still here's an interesting fact for you. In 2017, Bitcoin was up about 15x. There is no doubt in my mind that people lost money on Bitcoin last year.
Yep.
So with an asset that appreciated 15x, there are still people who lost money.
Yep.
So it's not just like, hey, everyone makes money in all markets. We just got to be a little bit more kind of realistic about, what happened, why did it happen, will it happen again, and if so or if not, what do we expect to happen, and how do we participate in it?
Yep. Participate and also protect against downside if we are participating. Wow, I really appreciated you coming on, Pomp. This was cool. I know a lot of people are dying to know more about security, tokenized securities, I should say, dying to know more about the movement, whether or not they should be involved, how to get involved, and also, that Tokenized the world little hashtag that you started, I think, has started a whole movement. Whether people like it or dislike it, it definitely got their attention. Thank you for coming on. It was a lot of fun talking to you earlier in the year about utility tokens and how this has kind of evolved, so really appreciate it. Where can people find you and find more info about what you're doing, everything like that? How can they keep up with you? What's the best spot?
Yeah, so Twitter, for sure, just at Pompliano. I'm on my Twitter hiatus right now. I will come back at some point. I don't
Figured
know
you
when.
would.
I'm a couple days in, and frankly, I'm loving it, man. I got all this free time. I'm getting all this work done. I've checked a couple of times on my notifications, and people are sending me memes and gifs and all this stuff telling me to come back, which is humorous. But we'll see. It definitely won't be in the next week or two. I think it'll be a little while, but I'll be back at some point. And then I've got a newsletter that I started called Off the Chain. The newsletter is just my way of kind of staying on top of what's happening, right? So every day I basically put here's the top 5, 7, 10 news articles, link to them, and then I really kind of told myself I want to sit down, I want to write, right? And so I write a blurb at the top that is my perspective on some piece of the news or something that's happening in either the blockchain or crypto world. And so that's just linked to from my Twitter bio.
Very cool. And then I believe you also have a Telegram. Is that still running?
Yeah, I've got the Telegram.
Cool.
I'm not as overly active as I was at one point, but now that I'm off Twitter, they're all being opportunistic and saying, "Hey, let's do Q&As in here." So
there you go.
So I'll hang out there a little bit while off Twitter.
There you go. We'll be looking forward to your return. It's ruthless on there, but it's a lot of love too. So thanks for coming on, Pomp. This was fun. If you guys are watching, make sure to throw a like, a comment what you want to see next, any topic, any question you still have that I can ask Pomp or that you can ask him, and then also throw a subscription so I can pump more of these out and get more of them to you. This will also be available in audio both on iTunes and on SoundCloud. Thanks everyone for watching. Cheers. Keep earning that Bitcoin. Stay well.
Thanks, buddy.